Hello, hello, hello. Welcome now, Stock Trades. How's everybody doing today? I just wanted to go ahead, as always, remind people that we are an educational platform. We do not issue financial advice. I'm not a financial advisor. We like to teach, and that's my passion. And excellent. Let me just on the phone here. But yeah, with that said, very, you would think after many days, a couple decades, you would think the world would somewhat be better. We would be more together and not divided. But today is 9/11. Shout out to the firefighters that risked their lives and all the people that really reminded us that freedom is not really free. Thank you for the military, for the folks that have defended us. And my condolences to all the American lives that were lost that day. This is something that we're not going to forget. You don't attack our soil and get away with it. So, and sadly, right after 9/11, we have 9/10 yesterday. So I wanted to give out my apologies, but I was met by just overwhelmingly just amazing people. Yesterday we were pretty, I was just pretty shocked. You know what I mean? Like just what happened. And I woke up this morning and I was just, I couldn't believe it. I was like, is this real? Is this real? It is. It definitely is. So in this video, we're going to go ahead and read the comments real quick and respond to some of them and talk about a couple things. I appreciate you, Massa. We're here. Excellent. What's the point of back-to-back videos where there's no new info? Still, I enjoy listening to Al. The energy he brings is great. So Triple S, there's actually some news, right? Problem is sometimes, again, retail investors, the stock market gives some hints, right? And it's up to you to pay attention to them. So we're going to go ahead and kind of talk about a couple of things, but there are a couple of hints in regards to macro data. Core CPI came in a little hot. Jobs reports, the job loss is actually high, which is pretty good for the stock market. Again, Wall Street's counterintuitive. It means it's going to be a rate cut. So usually September seasonality shows September being down. We've had this for many times, but I had a feeling, and I didn't really quite mention it this year, I had a feeling that this September may be different given that the market really was down heavily in April, right? For Liberation Day. So we're going to be talking about all those things. We're going to be talking about some things that I see to separate the signal from the noise. Okay, great. Too late to watch live in Sweden. Oh, I'm so sorry. I usually I'm a little later. Yeah, my bad. I learned today that patience is rewarded. And that's the thing. That's why we've created these lives, and I created this educational platform, and I use the stock that's hated. And I'm going to explain to you by a couple of quotes. This will be an educational video. I have some quotes from Peter Lynch that we're going to just be talking about, and hopefully that will add some years to your IQ and IQ years, whatever the hell you want to call it. But hopefully it increases your intelligence, and hopefully it increases your experience, because that's what we're all about. So yeah, patience is definitely rewarded. We're going to talk about the technical analysis of Clover Health, kind of what we're seeing. And we're also going to talk about Open. Open's a big one, right? Right now, what people are doing is they're pricing for the future, right? I'll give you an example. We're getting people. Okay, so I'll give you an example. Pretend like you have a student, and this student becomes famous and starts talking to Bill Gates, starts talking to all these people. And let's say all of a sudden you're going to go ahead and you're going to take your whole life savings and you're going to put it on the student, and you're going to bet on the student. Problem is the student, you don't really have a lot of grade reports from the student, right? You don't have you only have a couple years of the student performing, but the student hasn't even went into high school yet, right? So it's really hard to ascertain what the student's doing. So we need more information, but some people are willing to bet the boat on the student. Problem is, let's say the student grows older and then, stops performing well. Or let's say something happens, somebody leaves, parents get divorced. Regardless, what ends up happening is the investment now starts to be iffy. What's happening right now, and when you look at a stock, you have to ask yourself, why is the stock going up, right? And the best way to do that is to take a look at Nvidia, right? Nvidia is one of those stocks that is like, well, this used to be, and again, we if you go to our video on alstocktrades.com, our educational video, if you go to alstocktrades.com, there's a mastering stock market course video where in 2022 we talk about it when it was around 300 billion to 400 billion market cap. The stock price says it's the same, but it was technically $17. It's just they did a stock split, and that's why the stock looks the same right now when in reality the market cap was a lot lower. But the question you have to ask yourself is, why did the stock explode? Why did it 12x? Or really, if you want to go to peak to trough here, why did it go up 15x? Right? To answer the question, what you have to do is you have to go to the fundamentals. It always goes back to fundamentals. That's the first question I like to ask. So I open up the financial data analytics analytics chart, and I turn on the full screen mode, and then I look at Nvidia, and I'm like, okay, so what happened? Let me go ahead and screenshot, or let me zoom in. What happened? Let's look at the free cash flow. So the free cash flow in 2021 was $4 billion. Again, it's modestly going up, but what happened in 2022? It literally doubled. Free cash flow went to $8 billion, right? But then all of a sudden, free cash flow went down to $3.8 billion. The stock dropped in 2023. If you don't recall, we showed you here. The stock dropped in 2023, right? And it fell. It fell down to a low. And then all of a sudden, a smart investor would have seen they invested about $1.1 billion. They normally invest, they invested $1 billion and then they got like $8 billion back. They essentially got an extra $4 billion of free cash flow. Then all of a sudden they invested another $1.8 billion. And then something happened the next year in 2024. Their free cash flow went from $3.8 billion to $27 billion. That is unheard of, right? That is just a huge earnings surprise. So look at their net income. It went from literally $4 billion to $29 billion. Their earnings per share went from 18 cents to $1.21. Insane, okay? So whenever you have a company that goes from like 3 billion to 3.8 billion of free cash flow to 27, that's an explosion. Okay. So now let's go ahead and take a look at Open. Okay. Now, if you look at Open, hold on. Let's go back to Nvidia real quick. Look at gross margins. The gross margins, again, pretty good, improved, right? Now, if you look at Open, Open's net income, there's nothing really to it, right? Gross margins, relatively the same. Free cash flow ended up going positive and now negative. No really changes in investing. Now, if you go to the quarterly data and zoom out, the free cash flow did go to 821. So that is a positive. That's $821 million. And their net income is still negative 29, but an improvement from negative 92 million. But again, this is just one quarter. We need something that's long and consecutive. So what's happening right now is you have one stock, that Nvidia, that has proven itself that its fundamentals has changed. And then the stock repriced itself, and then people started to shoot Nvidia higher than what it was, just like Palantir. What's happening with OpenDoor is that now what people are doing is, the reason why it's been up the past couple of days is the old founders have returned. Okay, they came back. Second thing is, you got somebody from Shopify who came back, right? I believe the CEO. So you have people now, and their package compensation is very bullish. They're not going to be paid as much until a stock reaches a certain price. So what investors are doing right now investors are pricing into the future. The problem is if they don't meet that future, then the stock will collapse. Now, again, a lot of people felt smart when AMC went up by 10x, right? But then when it crashed back down to reality because the expectation was not met, you had a group of people that look how they live right now. They're like zombies, right? So ultimately, if OpenDoor is able to capitalize, and they're trying to capitalize on the momentum, they're bringing back the old founders. They're trying to create value. And right now, investors are willing to suffer short-term fundamental analysis pain for an outcome that is bullish. They're trying to essentially be able to create a shareholder value. The issue is, again, this is me basically looking at money, right? I worked hard to become a millionaire, right? I'm not going to just risk millions of dollars on a company that I cannot definitively say, you know what, I am certain that there's going to be a turnaround. Right now, there's a lot of frothiness in the market. There's a lot of speculation. And whenever you have that, you can look back in history and you could see ultimately the end of the story is if there's going to be two. There's a business turnaround, the stock explodes even higher, or two, there isn't, and the stock just crashes, and a lot of people lose a lot of money. And then you're going to get people saying, hey, you know what? It was a pump and dump, and that's fine, right? And then there's going to be uneducated people holding the bag. Now, again, if you look at the most recent institutional ownership data, it shows that the big dogs have been selling. Now, I'm curious to see if Q3 2025 showcases them buying. Because remember, Benjamin Graham in the 60s was really pissed off at Wall Street because they were buying into the hype cycle. Not only does retail get FOMO, Wall Street gets FOMO too, and they drive up stock prices as well. So we could see that. It depends. We could see that, but it's a hype cycle. You've seen hype cycles, and you've seen them crash. And again, there's a lot of people out there that want to be rich. They want to be millionaires, but if only you knew what it takes to become a millionaire, you would not just put out your money like that. That's why there's a lot of uneducated people that, I used to be one of them. Well, you have a lot of money, you could just donate. It's like money grows on trees. It's very hard, right? So whenever you get to a point where you have a lot of money, I think Kevin Lurie said this. First off, Charlie Munger said getting the first $100,000 is a bitch. The first 100,000 is I had to kill. Oh my God. I feel like the first $100,000 was harder than the first million. If you have the first $100,000, like I feel like that's good, right? The first million is, I'm not trying to downplay it. It's hard too, but 100,000 is harder in my opinion. The problem is going from $1 million to $5 million. Kevin Lurie, and I agree with him, he said that it's literally nearly impossible. Getting the $5 million is so freaking hard. But once you break out of 5 million, it's really true. You realize how hard was it to get that 5 million, and you understand the behavior and the psychology of what it basically took you to get that 5 million and more, to where you could technically, you know how to manage your situation to where you'll be able to know how to retire. And if you get to $5 million and don't know how money works, then most likely you're probably going to lose it. But if you got in there through hard work, then, right. So we spent some time yesterday on Charlie, and yeah, I my condolences to his family. Watch my video yesterday. I kind of broke down how everything happened, the shooting and the science of it. Yeah. But yeah, so I had beginners like, oh, no. Well, I mean, here's the thing. Again, I don't know if this is institutions also pushing it up now, shorts covering. Again, I don't know. It would actually be interesting to actually answer this question. So let me just hold on. Sometimes you just have to. I wasn't gonna do this, but I was just curious to see. No, that's not it. Let me see. Okay, go ahead. I'm just looking up right now though, because and there's a reason why we're spending our time right now with open, because this is telling you a story. Okay. What is this? Let me log out. Yeah. I know what I did. I'm into a wrong account. Hold on. Okay, got it. Excellent. Okay, so we got it. So now let's go ahead and let's showcase this. So this is OpenDoor. This is the short interest. I'm curious. So in the past 3 months, short interest went to 31, and then it started falling. So something happened in August where short interest fell. So after like August 8th, shorts were like, I had enough. So let's see what happened on August 8th. August 8th was here. Shorts started falling down. They started covering, and the stock started rising. So here it is now. I'm curious to see days to cover. They're like it's less than a day, so they're liquid to get out. The past 2 weeks, let's see. Short interest is slowly starting to go up again. So it's going to be very interesting to see. I'm curious to see for Clove what's going to happen. Yeah. Clove short interest is falling down the past 2 weeks. Let's look at the month. Yeah. So short interest is falling down now. Let's look at the official report here, and let's kind of open this up right now here. And let's just remove all this garbage. So we could see now we spiked up here, and then short interest fell, and then the stock price went up, and now we're spiking up here again. And the question is short interest going to fall? And then are we going to have another rally for Clover Health? So it'll be interesting to see this kind of like a kind of hoopah type pattern. But again, they were net income positive there, unless they pull a Houdini on the next earnings report. But if we go look at the official report for OpenDoor, I'm going to kind of remove all this junk here, and I'm just curious to see. Oh yeah, so if you look at OpenDoor, the shorts. Oops, no. Hold on. The shorts are there it is. You could see here the shorts. Oh, I hate. Oh, what a shitty software, dude. I can make better software. We can make way better software than this. You know what I mean? Like I'm in my developer mode right now. Okay. All right. So we're just gonna have to kind of scroll a different way. So you could see that short interest is high, and the stock is ballooning up. So I would be curious to see what institutions are doing with the OpenDoor stock. Are they buying or selling? It's very clear from Clover Health they're buying, especially from the most recent one. So this will be interesting to see. But we talked about this. Now what I want to do, just kind of recap. How you doing, ZZ? Appreciate you. What's going on? What's going on, Dr. K? Okay, so let's just kind of follow along here. So when you look at a stock price, it can go up two different ways, right? It could go up through a fundamental analysis or an earnings surprise, because the business is actually worth that much, and there's an intrinsic value to it. And the best way to explain it is you live down the street and there's a couple businesses that are on sale. None of them are making money except one. All of a sudden, how about this? None of them are making money, and then all of a sudden next month one of them starts making money. Let's say all of the businesses are selling for $1,000, but they lose you $1 million a year. So it's like it's not even worth $1,000. But all of a sudden, one business ends up next, like this month, one business, instead of losing $1 million, now it's making $1 million, and it still cost $1,000. So you're starting to see why stocks go up from a long-term perspective, like from a long-term, not like a pump and dump. See, retail investors, they just love, they want to get rich quick, fast, but it's not. If you do that, you're going to end up being poor because you're going to end up catching the hot potato and you're going to lose your money, right? So let's say that business makes $1 million now versus losing $1 million, but it still cost $1,000. So you can see how I'm paying $1,000 to make $1 million. That's unheard of. That's like asymmetrical opportunity, right? Just like how I looked at book value, right? I'm like, wait a minute, I'm buying this at liquidation prices. I'm buying this with more cash than what they are actually worth. Whoa, that's what Benjamin Graham did, right? Because if you pay $1,000 to make $1 million a year, it's better than paying $1,000 and losing $1 million a year. So you can see how profitability is important, to where once Clover Health becomes profitable, people are going to be like, wait a minute, this costs this much. I can pay, this much money to make this much money back. And it's harder to see it with stocks because you don't get that money directly. That money in a growth company ends up going back into the business via share buybacks or growth. And for retail investors to understand it, they always think about dividends. They're like, oh, when are we going to get dividends? Like some idiot for Palantir asked about dividends, and they're stupid because dividends is more of a late stage of a company like Coca-Cola. It's on it's downward. It's done growing, right? Again, retail investors don't know life cycles of a stock. But by you listening and understanding this, it's about how can I accrue long-term wealth. And the problem is with retail investors, they always want to, I want to make $1 million in a month, and it just doesn't work that way. And if you do it like that, then you can lose that within a month as well. Just as how fast you made it, you can lose it just as fast, right? So, and it's hard to talk sense when we're in a bull market, but it's okay because that's good, right? And I'm going to explain. So now we're going to go to the technicals here. So if we go ahead and look at the technicals, this is IWM. Okay, this is small caps. And as you can see, small caps has been on a rampage. I mean, just look at small caps. They have been flying high each and every day. And you can see why, Clover Health is going up. OpenDoor, a lot of the small caps are actually going up. And today was actually a pretty bullish day because we are breaking, I believe we're almost now at new all-time highs. We're getting to a point where we're going to be at new all-time highs. If we go ahead and look at the weekly or the monthly, or, how about this? Let's look at the just the quarterly. You can see now we are getting to new all-time highs, right? Now, from a technical analysis standpoint, let me kind of zoom in here so we can see. From a technical analysis standpoint, there's going to be rate cuts. There's going to be a FOMC meeting next week, and most likely we're going to. I am 99% sure we're going to get a rate cut. And I feel like this growth is overbarring itself. So what I mean is, I think we're going to grow more, but ultimately, the RSI does look overbought. And we are going to get into a position where it is going to be higher than what it is. And we are going to get in a stall out phase. So I feel like in October, and we might stall out a little bit on small caps, maybe consolidate a little bit because we need to have some consolidation. and we might consolidate right back on this potential support line. Now, previously a resistance line because we missed it here on, right? So we are getting, and it's funny because we got this dip, and then now this is a golden cross. We're back above the 200-day. And interestingly, as it started going up, look what happened to CLOV, right? So now CLOV is fighting its way back up to the 200-day moving average. Okay. So I think we're going to potentially reach this. We can go as high as, potentially $3.38. And I feel like we might miss the 200-day, and we're going to fall back down, and we might touch the 50-day. So it might fall back down to the 50-day, or it might fall back down on this diagonal line. Okay. And then as the market proceeds, I think then once we cross over the 200-day simple moving average, I think that's when it's going to be very bullish. I mean, we're going to get back to the, I believe, a rally. We're going to get back into that rally cycle. But let me explain why this one is going to be different. We have a couple things going for us now, okay? We have the whole social sentiment, right, of AI sentiment, with the Congress, Robinhood Summit. We have a lot of folks locked in and saying, wait a minute, there's something special about this company. I don't know what it is, but it looks undervalued. You have a lot of people now, once they saw SoFi at $25, OpenDoor is now at 10, and who knows, it might, because, you saw the intrinsic value I did a couple months ago when it, I said the high is 15. It could even go higher because, again, it could go above intrinsic value. But the problem is that's intrinsic value priced at perfection, right? That's retail investors saying, you know what, it's fine. I will buy OpenDoor at a price of what I expect to see it in 2-3 years from now, hoping that when I get to 2-3 years from now, the market would see it from another 2-3 years from now, so it could become 30. That's how the market's saying it. It's like you go ahead and buy a business, it's worth $1,000, but you pay $10,000, right? And you're like, I'm okay paying $10,000 because in 3 years, I think it will become a $10,000 company. And I hope that when I go into the future in 3 years from now, people will look at it 3 years in front of that, right? So let's say 2028, it'll be $10,000. I'm willing to buy it at $10,000 now. So by the time 2028 arrives, people will be looking at it in 2032. Problem is you can't do that, because what happens if there's a recession, a bear market, correction? This is where you got to look at margin of safety. Right now, there is no margin of safety for OpenDoor. You're buying it above you're buying it at a big ass premium, right? So what now, right? So SoFi is up, OpenDoor is up, and those are Chamath specs. So what's going to end up happening now, people are on Twitter and they're kind of think about it. They're like, wait a minute. The only Chamath SPAC that hasn't gone up yet is Clover. I think CLOV might be the next one, right? That's what they're going to think, right? And then you have that. So now you have people, because again, this is common sense, okay? And think about it. Institutional ownership is already going to be above 40% by then. Who knows? Institutional ownership may be above 50, maybe above 50 or 60. Okay. So you're going to have institutions that are ready to go. You're going to have JP Morgan come online because they're buying right now. Once their appetite is full and they're ready for the stock to go up, they'll come online to the earnings call because they're buying right now. You can look at the SEC 13F filings, right? And once they do that and the market ends up basically, analysts are coming back online. You have that. You have retail investors that are hungry, that are wanting for it to grow. You have rate cuts. We have a rate cutting cycle. You saw it on the All In podcast that just had last week. They said that we're going into a rate cutting cycle. So the market's going to be pretty frothy, right? So you have that happening. You have rate cuts that are going to happen. We might even have a 50 basis points. I mean, who knows, right? The market's is expecting, 2 to 3 cuts this year and then 2 to 3 cuts next year. So 5 cuts on average to 6 cuts. So imagine you're going to have rate cuts in 2025 and rate cuts in 2026. Holy shit. So you're in a rate cutting cycle. Okay. And on top of that, now you have other healthcare stocks that are rising. So someone said no news has developed. Well, that's wrong, right? Let me explain. So if you look at United Healthcare in the past month is up 40%. Year to date, it's still down 29%, but you remember it was down a lot. Like it was like literally down 52%. And then if you look at it from peak to trough, it was down 60%. Now all of a sudden it's recovered 48% and it's starting to recover. But the story's not there. If you look at Humana year to date is up 10%. Centene year to date is still down a lot, but look, in the past month, it's up 34%. Alignment Healthcare is up 41% year to date. Oscar is up 43% year to date. Now watch this. Clover, guess what? Year to date, it just broke out of negative to positive. So think about it. In the past couple of months, Clover has been negative on the year to date analysis. And finally now we just basically broke out to a positive year to date. So if we were to compare now ourselves with other positive year to date stocks in its caliber, you would see Alignment Healthcare, Oscar, et cetera, in terms of the smaller textile stuff, companies, right? I know Oscar it's not like 100%, it's not MA, right? But you're starting to see Humana 10% year to date. So now, and I told you this a month ago, right? If you don't recall, a month ago, I went ahead and I posted a screenshot. If I can find it. Here. I posted a screenshot and I said, over the past, and this was on August 19. August 19, I posted a screenshot. You can look at United. United was right here, August 19, and you could see it explode, right? And you could see August 19 for Clover is right here, August 19, and then you could see up 24%. So what did I say August 19? I said over the past week, sector performance data shows a clear divergence. Real estate, consumer, and healthcare are seeing notable inflows, while traditionally areas like technology, et cetera, have dropped. So it's weird because healthcare, if you don't recall, was down here. If you look at the past 5-10 years, healthcare has actually been a very shitty stock to own, right? That whole sector has been trashed. That whole sector has been shit on. It's been literally shit on. But all of a sudden we started noticing, I think this was before the Warren Buffett buy, I think, right? I have to double check, right? But you could see the sector analysis. It shows that Wall Street's starting to maneuver in healthcare. So because we're starting to maneuver in healthcare now, I could imagine what the year-to-date analysis is going to be looking like for healthcare stocks. The fact that now we're above 0%, it shows that potentially Clover may actually end the year on a positive note. Who knows? Again, we have rate cuts, potentially Christmas rally. We are going to be seeing, Q3. We'll see what Part D brings. And then star ratings are coming. Clover knows what star ratings they're at right now. So we'll see what the star ratings are going to be. I don't know. I need to do more due diligence, but we'll see what the star ratings are there. We have bipartisan support. So I'm looking and I'm kind of graphing everything in my mind, and it's looking pretty bullish, right? And what I've been doing, I've been essentially buying at these levels, right? I've been buying a shit ton of stock. Not financial advice. That's just what I'm doing for my future, right? I've been buying, and ultimately, I can't wait to take advantage of the wheel strategy once this gets to intrinsic value and beyond. Now, again, let me be very clear, okay? We also got the insider buy from Vivek. I mean, it was insane. I mean, we had retail investors saying that this thing was going to go to $1. I mean, it was wow, right? So, all right. So check this out. Just like how a stock trades below intrinsic value, stocks will go above intrinsic value. The past 2-3 years have been very terrible for stocks that are small caps and unprofitable. Just imagine I want you to think to yourself right now. Imagine once Clover showcases its first counterpart SaaS revenue. What do you think is going to happen to the stock price? We saw the subdomain analysis and we saw Scribe, and then we saw a press release about Scribe. We also saw a subdomain on Humana. This encourages me, and obviously some weirdness going on from Humana using the same words as Medicare, medication adherence, and whatever. This kind of increases my probability that I believe that there's definitely something happening with Humana and Clover, especially with their 3-year J-curve projection. So I want you to think for yourself, right? We're not going to go ahead and spoon feed you here, right? I want you to think for yourself. What do you think is going to happen once Clover announces their first SaaS revenue? I mean, literally just kind of really think to yourself. It's very clear that the stocks are up right now because retail is piling back on. There are a lot of retail investors that sold, and maybe a lot of them are coming back now. Speculation and frothiness are coming back. You can see how buying into fear is actually good. It's actually good to buy into fear. You see automatically a rewriting of the covered calls and cash secured puts now in the options. And I feel like if this continues to go the way it is, it's going to get better. You're starting to see Centene, all these other healthcare stocks rise back to try to recapitulate or try to get back into their mean reversion. So if you take all that data, and if you add the next layer, which is Clover Health is not just a Medicare Advantage plan, it is an AI tech platform. What happens when they get all that revenue? I want you to, again, I sometimes I'm not clear with sometimes I'm just not clear. And you guys need to help me. That kind of looks weird, dude. That looks like that looks like you saw that photo? Looks like I got, what the fuck was that? Ooh, what's that? Looks like that was weird. Okay, so all right. Sometimes I'm not clear. But let me just go ahead and be clear. So I have to find here it is. So open evidence revenue rate is $50 million as of July. Okay. So I want you to think to yourself, an annualized rate of estimated $50 million. That's not huge. Okay. Now just think, I need you to think. Open evidence, which I've shown you, it's this here. I use it. Every healthcare provider uses it. But I want you to think. Open evidence is going to make $50 million this year. And it just completed a round for a $3.5 billion evaluation. And this is the private area of the company. So think about it. So if you take 50 million divided by, or 3,500, which is in millions, right? It's 3.5 billion divided by 50 million. That is a price to sales, or price to revenue, price to sales of 70x. 70x. So just imagine, what do you think is going to happen once Counterpart shows its first revenue? And again, this is in the public markets too. Who knows? Right? There it is, James, right? Al is a teacher at heart. No, I appreciate you, man. I love, honestly, man, I would love to teach kids too, man. I love teaching. I love teaching, right? I really do. I love teaching. And I'm not just listen, guys, I'm not just teaching you like bullshit, theoretical. Like I'm teaching you some good shit. You know what I'm saying? This is some good stuff, right? It's stuff that I wish someone taught me. Okay, so check this out. So it's 70x. So let's just kind of play some napkin math here. Forget Iowa Clinic, forget Duke, forget them all. Focus on Humana. Let's just focus on Humana. Humana on average has Medicare Advantage of 100 mil. Okay. 100 billion. Let's say, for example, we save them 10% per year. That's about $10 billion. Let's say we do a shared savings model where we take 20% of that. That's $2 billion. If we were to be priced at a price to sales of 70, just to give you just kind of an idea, that's $140 billion market cap. You multiply that by 2, that's a $280 stock price. Now, let's say Al is full of shit. Let's take 90% off of that. And let's take 280. 20. Subtract it from 252. I should have just multiplied it by 10%. That's still a $28 stock price. That's saying like, Al, that's bullshit. Let's take 90% off and you still get a $28 stock price. Unbelievable. And that's not including Medicare Advantage. Right? So you starting to see it. And again, hindsight's 2020. If you're watching this video from the future, it's already too late. If you want to learn how this works, I have a platform. If you're out there, you could be watching this 5 to 10 years from now. Hindsight's 2020. And once people watch this in the past, they're like, oh my God, it just makes sense. Why didn't I think about it? It was so clear. That's Wall Street, man. So without further ado, let's go ahead and look at some quotes from Peter Lynch. Again, Peter Lynch, that software I got, literally, it's like $20,000 now. It's insane. Okay. So let's go ahead and look up some quotes here. So know what you own and why. You must be able to explain in 2 minutes or less what a company does and why you own the stock. Okay. I like Clover Health because they use their Clover Assistant to reduce medical costs by over 1,000 basis points. They have a flywheel business model. They're a return to growth phase. They have high gross margins, higher than anyone in the industry. And now they have Counterpart, which is their AI sub-SaaS. And they have a lot of industry veterans in their company. And they're on their way of becoming free cash flow and net income positive as a triple dragon. Done. That's it. It's easy as that. Bingo. Right? Whoever tries to explain to you more, they don't know. They don't know what the fuck they're talking about. They're gambling. Okay? All right. Next. If you can't do that, then you don't understand the company. Your decisions will be influenced by the market rather than the business. There it is. Done. We have one lifetime access member where you ask him a question, and you know what he does? He answers. I don't want to say this because that's gonna affect that's gonna be very. We're not gonna say that. I'm gonna skip it. I'm gonna give another example. You ask him a question, and he goes like this. Hold on. Let me explain. Hold on. Online drawing pad or whatever. I used it yesterday. There it is. Remember this yesterday? So how do we do this? Let's clear this. Okay. So let's use black. Okay, so check this out. So here's point A and here's point B. Normally when you talk to someone, they answer the question directly. Sometimes people say they make another point and another point to get you to get you to this point, right? You know what this guy does? You ask him a question and he goes like this. don't you think he's going to go, woohoo, woohoo? And then he comes here and he says this, New World Order. What the fuck? Yeah, right? So the point is I'm making all these noises and my dog is like, are you playing with me? Let me move the mic here. Oh, thank you. Give me a kiss. You see how he turns his head? He's like, Dad, are you playing? Why are you making these noises? Oh, I love you. No, I woke up the dog. He's like, what's going on? I was like, woo! You're funny, bro. You're good? You want to say hi to the team? You're so cute. You're so cute. Smile. Oh, you're so cute. Give me a kiss. I love you. I love you. Can I finish my life? Okay, I know you want to kiss me more. Okay. Want to go for a walk? Okay, all right. We're going to go after the live, okay? All right. After the live, promise. Okay. See? He's like, okay. Right? I think Al has lost it. No, seriously, gunslinger. So I'm like literally making out with my dog, on live here. He was kissing my chin. Sometimes he tries to get a couple licks in, but I refuse. I said the word. That means within the next 15 minutes we're gonna end the live. He's waiting, looking at me. He's like, so we're gonna go outside, right? Okay. So the point is we have a member that you ask him a question, and he just goes all this, and then all of a sudden he says New World Order. I mean, it doesn't make sense, right? So it goes back to essentially what Peter Lynch says. If you can't explain it in less than 2 minutes, then you don't know what you're doing. You don't understand the company, and your decisions are going to be driven by the market. So, which is why, and again, that's what that person does. Whatever the market does, he does. If the market goes up, this thing's going up. If the market's going down, this thing's going down, rather than being consistent into the business, right? Markets goes up, markets goes down. Ha, hoo, he, hoo, ha. And the problem is the market doesn't make sense in the short term. The market, so what you can be doing is you're trying to rationalize an irrational market, right? It's like basically trying to speak to a patient that's undergoing a psychiatric breakdown and trying to basically explain to them math. Like, good luck, bro. Okay? All right. Next Peter Lynch advice. There's always something to worry about. Even in best of times, there are uncertainties. That's part of the game. And it's good to be aware of them, but never let them stop you from investing in a good company, right? There's always going to be issues, right? DeepSeek is a problem, right? COVID, Trump, China issue in 2018. There's always going to be a problem, okay? But you have to learn how to separate the noise and extract the signal. What did we talk about yesterday, right? With creating mental models. In fact, here, let me show you something. Let me show you something. One moment. How the hell do I do this? Let me show you. So I'm going to show you 2 screenshots right now. I just sent it from my phone. These are very educational, in my opinion. Okay. Let's save. Let's save. Oh, no. Hold on. Okay. Stupid thing. Okay. Hold on. Go here. Actually, you know what? I don't need that. Let's. I was going to show you guys this. I forgot. This is very important. Okay. So, Charlie Munger was Warren Buffett's right-hand man. Without Charlie Munger, Warren Buffett wouldn't have become a multi-billionaire, like billionaire, right? And it's because Charlie Munger taught him how to buy good companies like See's Candy that was trading above its book. While like Benjamin Graham focused on like bottom rock investments. Like, for example, we had one member, Irish Vanity. If you're out there, Irish Vanity, he was kind of going along his, there's different stages that an investor goes into, right? There's a stage of where we go in and become the Benjamin Grahams, right? I started at that, and all I would like to do is purchase value. And I like to find asymmetrical opportunities. Now, the problem here is when you start to look at a company that's priced above value at a fair price, but it's a great company, Benjamin Graham ignored that. Then came Philip Fisher. And that's where Charlie Munger learned from. And then Warren Buffett was also inspired by Philip Fisher. And I was talking to Irish Vanity when I put out a price target of Nvidia when it was before stock split. It was around $170. And I said the price target is $700 to $800. And the stock rose up, it ended up rising to that. But Irish Vanity said, that's too expensive, man. Are you nuts? And the problem is because he was doing the Benjamin Graham model of investing. He makes his video analysis, and it was just the Benjamin Graham model, the Graham model. Again, I went through that phase, but there's an evolution that you go through as you become an investor. You can't, right? So the Ben Graham model will help you, but it won't help you catch like a See's Candy or like an Nvidia or an Apple, right? So it's different. So Charlie Munger was the person who was able to open the cocoon of Warren Buffett. And I agree with Munger here, okay? So this is what Munger said. So this is what Munger's philosophy is. And I recommend getting his almanac. It was very nice, right? So let me show you. Charlie brought not only financial acumen, but also the foundation of business law. He also brought an intellectual perspective that is quite different from Buffett's, right? Charlie is passionately interested in many areas of knowledge: science, history, philosophy, psychology, mathematics. And this is where I need you to open up your ears, remove their dust wax and, earwax, and listen. And believes each of those fields holds important concepts that thoughtful people can and should apply to all their endeavors, including investment decisions. Okay? That's exactly what he said. Absolutely. So I want us to go back now, and I want you to read what Charlie believed in. He believed in that knowledge, science, history, philosophy, psychology, and mathematics, all of these combined will help you become a better investor. So when people ask, and people say, why are you talking about Taylor Swift, right? Why are you talking about all these things? I'm trying to teach you the psychology of how people perceive things, right? A lot of people believe in the first thing they hear, and they capture that. And it's so hard to unlearn that, right? And hey, how you doing, Shay? What's going on? So the problem is you get to a point where, if people just think that not understanding philosophy and not understanding psychology and mathematics, you'll be an okay investor. If you don't understand these three things, then you are not going to be able to create generational wealth, right? Unless you have a business and you're a master at that. But ultimately, throughout the business, you will ultimately learn philosophy, psychology, and all that, because all those are intertwined together. Now, again, that's what we like to teach, right? It's, you haven't realized that's why we have a I always talk about the psychological outputs of things. And somebody just mentioned it right now through their experience in the stock market. I learned today that patience is rewarded, right? But the problem is you can have patience, but if you don't understand the math, then you would be dead, right? Look at AMC. AMC investors have a lot of patience, but do they understand the math? No, they don't understand math. That's why they got caught holding the bag. Look at now AMC investors with, you think they understand philosophy? You think they understand that movies are headed more towards, streaming, that maybe that might affect the business model, right? So they don't understand philosophy. They don't understand math, but they got the psychology down. They understand that the problem is, yes, you can wake up every day and you can work on a goal and never give up. But at some point, you have to understand if this goal is a loser or a zero or a hero, right? I can work on something that's not going to be fruitful for 10, 15 years. And what separates someone who's a smart CEO versus a dumb CEO is a smart CEO is able to know that business model is crap. There were people on our stock terminal that disagreed with me when I said that Andrew needs to exit ACO. And within 3 months, he exited ACO. That was the smartest thing that he could have done. And as soon as he did that, I'm like, this guy knows what he's doing. I trust in management. Okay? So Charlie said that, right? So you have to understand not just the investment, you have to understand other aspects of life. Okay? Okay. And, I'm not talking about, if you want to do pump and dumps all your life, go ahead and do that. You don't need to understand anything for that. It's just all technical analysis. But again, you're going to, if you look at the top 10 of the wealthiest people in the world, the billionaires, they're not day traders. Okay. So I'm trying to teach you what Warren Buffett is a value. I'm trying to teach you what value investors do. Right. And if you want day trading, this is not the right channel. That's not what we do. Right. We have software for it. It's great. But again, you got to understand the whole picture. Okay. So now let's go ahead and I have to watch the rerun, but I appreciate you. Love you, Patrick. All right. So now earnings equals performance. In the short term, earnings and financials can be ignored. Stocks react to headlines and macroeconomic situations, right? So in the short term, it's okay, right? Stocks go up. They don't give a shit about fundamentals. They ignore it. But in the long term, there is 100% correlation between the success of the company and the success of the stock. If the company's not successful, the stock will not be successful. Look at AMC. Look what happened to them. The company was not successful, and ultimately, they did a selling plan, those sons of bitches, right? The guy, and he pretty much sold retail all those shares. So you want to look for mismatches between stocks and earnings. So what I did is I said, wait a minute. Clover, and I can show you again. I can show you here. You go here and you type in Clove, and you can ultimately see on the quarterly, look, the stock price was going down as the net income and free cash flow was becoming less negative and soon to be positive. One of them is positive. So you can see how the company's getting better and better from an earnings perspective, but the stock price in 2021 went from $28 down to 60 cents. In 2024. So you could see how there was a mismatch, right? That's what we're trying to teach here, right? There's a mismatch, right? And these things happen a lot, more frequently than what you think. Not to that degree, right? That's lucky, right? Well, we found that, right? But there's mismatch, like for example, Meta. Meta went down from $400 to $90. Now it's at $600. Last time I checked, let's say Meta right now is $750. Okay. All right. Now, it's a numbers game. If you research 10 stocks, you might find a good one. If you research 50 stocks, you might find 5 good ones. If you research 100 stocks, you know the drill, right? Peter Lynch retired around in his 40s. It's when he started to know all the 2,000-3,000 stock tickers, but forgot the names of his children. That's when he said, you know what, I'm going to retire. I'm done. Right. And he turned like 20 million or 40 million, 20 or 40 million into like 13, $14 billion. It's insane. He turned like nothing, multiple billions of dollars. I have to double check. I need to see this fact. Let me think. Hold on. I got to see the fact here. He turned 20 million into $14 billion. Holy shit. Okay. That's tough. That's like Clover, which is not happening in my, like, I don't think that's like Clover going to $2,500 stock price, just so you can see, from 60 cents. So just so you can understand the power of Peter Lynch, right? Peter Lynch ain't no soft hitter. That guy's a man, right? That guy knows what he's doing. So here it is. Okay. So if you research 100 stocks, you know the drill. Buffett used to go through thousands of stocks. The really great opportunities were obvious, right? It's like literally a 4x2 hitting you in the forehead. But often they were the 500 stock he looked at. You see, Warren Buffett went through 500 disgusting stocks, and after the 500th one, he found one. You see what I'm saying? So that's why I created an educational platform. I hope now you can see my vision. I created an educational platform where I will teach you Warren Buffett, Charlie Munger, all that. But then guess what? I have the data where you can go search those stocks. And then imagine having all these people, and we have them now, and each and every one of them searches all the stocks for healthcare, all the stocks for this, all the stocks for that, all the stocks for this. And then all of a sudden, we all pile in and they'd say, after searching my 100 stock, Al, I found this one. This is a really great one. And that, those are your triple dragons. And hey, guess what, guys? It's okay if you find a stock that's the triple dragon many years ago. If there's an asymmetrical opportunity, it's okay. Okay? All right. Look at Nvidia, right? All right. Outplaying big money. Here's a good one. In the last decades, institutions took over the stock market, right? But that can be an advantage, right? Institutions took it over. Now watch this. This is where the advantage can lie. Playing in fields they can't play to win the big prize. Small, illiquid industries. Clover was small, right? No one cared about it, right? Unpopular stocks, their big clients don't want. Like, I don't want that, right? The geographics they don't care about, right? People didn't care about AI and healthcare, but now they're starting to, right? Likewise, personal edge. Your personal edge is something no Wall Street analyst has. Invest in what you know based on your job, your hobbies, or as a customer, as a consumer. That's what Vivek was saying. If you're an end user product and if you see the product is good, gross margins are good, you see how you're taking in all different forms of philosophy, psychology, mathematics, and you're putting it all together to formulate your thesis, which is why I love our lifetime access members, because we have truckers, we got plumbers, we got doctors, we got pilots, we got lawyers, we got people that work in software, big tech industries. We got them all, right? We got janitors. We got them all. We got them all, right? We got teachers. We got people that are retired too. Hey, shout out to you. But all of you guys have job experience and hobbies, right? And all of that can come together, okay? Often the companies you know from a personal experience are great businesses, and great businesses often turn into great stocks because remember, there's 100% correlation between the success of the company and the success of the stock. If the stock goes down, if the company goes down, the stock will go down. If the company does great, the stock goes up. But guess what? In the short term, it doesn't make sense. Long shots almost always miss. Long shots rarely work in the stock market. They feel more common than they are due to this, surveyorship bias, right? It's like, oh, I know this guy who did it and that guy who did it, right? For one that worked, there are thousands that didn't, but we don't remember those. And people are like they just short-term minded. Do not believe in empty promises of utopias. Stick to the mathematics, okay? Afford to be patient. Patience is among the most important virtues of investing. Someone just said it today. I'm going to pull up the comment. Someone just said this today. James said, I learned today that patience is rewarded. What does Peter Lynch say? Patience is among the most important virtues of investing. If you choose good companies at a fair price, you have all the time in the world. Only when you buy hot stocks and long shots, time becomes your enemy. Because the problem is you're buying above margin of safety, right? You're buying above margin of safety. And what ends up happening is as time progresses and bad companies start showing their report cards, then the stock will go back down to intrinsic value, if not below. Right? So you see what I'm saying? Again, it's all mathematics, guys. It's all mathematics. I hope that this video was helpful. There's a lot of investing knowledge. It's going to take a while, but I hope that me giving you this increases your IQ. Peter Lynch said this, right? You do not need a college degree to be successful in the stock market. You just need to be patient. You need to be fearless. You need to be relentless, and you need to know what you own. And you just got to look at the math. And it's not hard math. Just like he said, relax. Don't worry about it. You can pick great stocks as well. All it takes is time and a little patience. I hope you have a wonderful day. I'll see you on the next one.